Good morning. This is the weekend update for Buy Sell Short for Saturday, October 20th, Friday, anniversary of 1987 crash. Not that it really means much, but the fact that we had a decent sized sell off yesterday gave the business media something to hype about, and probably ended up being a self fulfilling tragedy, for lack of a better word. Down 200 points. The real driver being the weight. We've been surprised over the last few days with all the warnings that we've been seeing from large cap techs, how the market was able to hold up. We had IBM get decimated, but the weight of the warnings and misses ended up just weighing on the market. Really started on Thursday with the mistake release by Google and its plunge, and then after hours on Thursday, we had Microsoft miss, we had GE miss, we had McDonald's miss. McDonald's probably the bigger of the misses, because what's been happening of late is when the large cap techs get hit on warnings, the defensive stocks sort of pick up the slack, and with McDonald's and GE to an extent missing and getting hammered, that really sent everyone to the sidelines, and what we saw was the doom and gloom retrace we had on Friday. Options expiration with the size of the sell-off really didn't help matters. We had little bounce at all. I mean, it was quite evident early in the day that we were going to be doing absolutely nothing. It was a falling knife day, high risk, not the kind of market I want to stick around and play, either long or short. And you go, well, the market's going down. Why wouldn't you try some shorting? Because quite honestly, any sort of news could come out and we could be back up all the losses just like that. Friday, we ended up right where we ended last Friday. So it's almost as if the rally we saw early in the week didn't happen. We're right back down, closed just below the 50-day moving average. Now, all eyes are going to be on that low we saw last Friday, early Monday. We could potentially see a dip down to scare out some stocks, but there's a lot of warning signs in the charts, and I'm inclined to be pretty cautious right now. I sort of mentioned that in the video on Thursday, how no oversized positions, adhering to stops. If stops hit, they hit, and that's what we're going to take going into this week. I mean, we're starting to see a lot of chatter about the fiscal cliff that's upcoming in January, and the election is 2 weeks away, and I can't recall a recent presidential election over the last few cycles where we've not seen some decent selling into and after the election. Now, the last couple of times that's happened, there's been other underlying currents in the market, and we have not had Fed money, QE money flowing in. So, I'm willing to take a extremely cautious stance, but it doesn't mean I'm going to go hide under a rock. If trades present themselves, we'll jump into them. As for the daily chart, volume has picked up decently over the last couple of days. Troubling trend is this downward trend, higher or lower highs we're seeing on stochastics on the Dow daily chart. So we're seeing momentum sort of fade away. If we look at the 15-minute chart, you can see the steepness of the sell-off, which is similar to what we saw 2 weeks ago, actually a week ago, and then we gained it all back in a couple of days. So this is the kind of market where that can happen. We are oversold on the 15-minute chart, and we did start to see a rebound into the close on Friday. Typically, going into a weekend, if I was looking at these, RSI breaking up through 30, MACD breaking up, stochastics breaking up, I would be saying odds are decent for a rebound on Monday, but I'd really like to take a watch and see approach on Monday and just really see what happens. Small caps have broken down, broke through the resistance line again, and probably have eyes on the 200-day moving average down there at 79.76. Now, one thing to keep in mind, we've got a lot of different things converging right now. We've got the election. We've got QE out there. We've got the fiscal cliff worry. But we also have year end for a lot of hedge funds. And a lot of hedge funds have really done terrible this year. And we could see a washout for tax selling right now. Also, keep in mind, we had mentioned it a couple of videos ago as well, with regards to the fiscal cliff and with either, if Obama wins, the possibility of capital gains taxes going up for high income earners, that we could see a lot of locking in of long-term gains to capture the lower tax rate into year end. Stocks like Google that's up 400%, or Apple that's up 400%, etc., etc. Now, while that may portend tough times going into year end, I would like to remind you that whenever we have that kind of selling, it usually ends up being fantastic for December/January pop plays. So with every dour outlook we have, we've got to look at the flip side, that this selling is going to bring us opportunities, and that's what we're looking for right now in the market. As for plays, stops hit. Friday, bone, looked great. Thursday, tried to break out, got sold off, and then got hit over the head on Friday with the market. Stop by play. Simple as that. Where would I rebuy this stock? If we saw a decent-sized rally in the market and or this one clear 139. So stopped out. It sucks, but that's where we are. ANTH, we also stopped out of our scalp shares at a break of the 50-day moving average at 97 cents. If you're still in the core shares, it's one of those stocks you could probably just sit on. I mean, it's had a pretty stable chart and it's just getting hit on the market. We'll look for a decent add opportunity in the coming days or a rebound in the market. ECTY actually was up on Friday. Again, this is one of these plays, it's okay to hold a really small position with 43-cent stops waiting for the news on their charging and new revenue flows. Same for PTN, which actually closed up as well. This is one we're sitting on waiting for news regarding their phase 2 drug. Now, this back and forth action we've seen over the last week or so on the chart, in the stock, has actually made the chart look much better. Breakout is 75 cents. RSI has held 50. We're looking at a positive MACD cross. Stochastics has held its support line around the 40 level. I like that. And on-balance volume has held up well, so we're not seeing real selling. The selling that we see typically on this stock is low volume sells early in the day to scare out shares, and then they buy it up into the close. That typically is bullish. So this is another one of those wait-and-see stocks. Gale, which was a awesome winner for us, gave it all back with the market over the last 2 days. Very, very frustrating, but it's right back down to support at the 20-day exponential. This is just how Gale rolls. Uptrend support is, probably 175 to 80 area is support on this stock right now. And again, another one, great setup. Would love to see it start to rebound off that 20-day exponential on Monday, but not going to force it. PopScan is, of course, devoid of plays, really. Only a couple of plays on it. If you look at the PopScan, you'll see a space and then two other stocks, Sienna and AKAM. Let's just pull them up. They're potential short candidates. Possible breakdowns in them with tight stocks. I mean, tech has been taking it, just been taken out to the woodshed and beaten over the head. So these tech stocks charts look like they're breaking down. And AKAM has been just a perpetual warner over the last couple of quarters, and has some potential downside risk. Haven't looked to see when its earnings is, but selling is starting to accelerate on this one, like many other tech plays, and could make for a nice little short play if the market continues its downward trend. PopScan is at pretty low levels right now, which could indicate a rebound, but that's why we're sitting on high cash, and we'll trade what comes. We're not going to force any trades. We're not going to trade to trade. We're just going to sit back and see what the market brings up. I would suggest, especially for you new guys, going to the education section on the website, scrolling to page 2, and there is a video on trading iffy markets. It was done a couple years ago. Ignore the stocks and the indices, but the underlying theme applies to all markets. One thing I like to do when markets get iffy like this is to increase my cash position. A market like this right now, where we've got a lot of iffy things going on, I would look to be 85 to 90% cash is where I would look. Now, of course, small accounts really can't do that, but that's my ideal cash position. And typically, on an average day, I'm always 50% plus cash, just to give you a baseline number. So I don't look to play with all of my money in the market, even in the crazy mania times. And when times get uncertain like this, I like to increase my levels. The plays I would hold would be plays like ECTY. MOTR actually gave a nice little ad opportunity. We're about to get a positive MACD cross on this one, but it's got hit over the head on the market. Now, a lot of these stocks sitting in the basement, the downside is pretty limited. I mean, we had Icon buying up 30% of this stock a few days ago. We're just waiting for the downtrend break on this one to move. These are the kind of stocks you can sit in small in. You don't put 10% of your account into these stocks. You play small. You stay nimble. If the trades don't appear, you sit on your hands. I mean, if I was to tell you guys only one trading lesson, it would be not to force trades when the market is iffy like this. There will always be another day. There will always be another trade. Don't blow your cash, or don't blow out your account trying to make money in a market like this. Just sit back and wait for the correct time to trade. And hopefully, this sell-off, which, by the way, as I've mentioned before, during quantitative easings, are not uncommon to see 5 to 7, 800 point retraces in the market. And just to give you a case or an example, from the June bottom, we are up 1,600 points or so. A 38% Fibonacci retracement takes us back to this 13,200-ish area. A 50% Fibonacci retracement takes us back down around the 200-day moving average. These are commonplace during quantitative easing rallies, and we are starting to get our first post beginning of quantitative easing sell-off, which has been typical during the past 2 cycles we saw. So none of this is out of the ordinary. And remember, we've got an election in 2 weeks. We've got fiscal cliff fear-mongering out there. So there's a lot of headwinds, and the earnings report have really sucked. I mean, what's funny about the earnings reports, and you're not hearing it talked a lot about, is the likes of Google and Facebook and Intel. Intel is getting hurt because more people are using tablets and smartphones. Google and Facebook are getting hit because people are not really clicking on mobile ads. So we've got people transitioning to smartphones and tablets, but companies, even the smart ones, not being able to figure out how to monetize that yet. So, there's a lot of interesting things going on in this market right now, but I would say, every storm passes and the sun comes out again, and, we need a sell-off. Reboot all these stocks. We rebuy them again for the run-up. I mean, look where we were a week ago. We're right back to where we were a week ago. We rode it up, came back down. That's how the markets work. So that's it for the video. Definitely check out that video for a refresher on playing an iffy market. And if you've got any questions, shoot me an email, feedback@buysellshort.com. And I will see you guys in the chat room on Monday. Have a great weekend. Bye.